Good afternoon and welcome to the Staying Ahead by Thinking Differently panel. I'm Yakob Peterseil. I'm an editor at Bloomberg in London. Now, innovation has really been the lifeblood of the ETF industry from the very beginning. In fact, it's easy to forget just how different and revolutionary these products were when they first came along in the early 90s. Since then, we've had a steady drumbeat of new progress to the point where today we have ETFs that actually pay you to invest. We have funds that don't have to disclose their holdings every day. And that's just from 2019, so pretty incredible pace of progress. So innovation is alive and well in this industry, but it's a double-edged sword. As we know, last year we had some controversy over the inverse volatility products in the US, which some felt was an innovation too far. But that's exactly what makes this such a rich topic for debate, and to do so, please join me in welcoming my panel. To my right, Richard Flax, Chief Investment Officer at Moneyfarm, which is one of the biggest digital wealth managers in Europe, including here in Italy. Prior to Moneyfarm, Richard held roles at PIMCO and Goldman. So welcome, Richard. In the center, Manuela D'Onofrio, who is head of Group Product and Investment Platforms at UniCredit. Manuela is actually in charge of deciding the asset allocation for UniCredit's private banking clients, and in that role uses ETFs. So welcome, Manuela. And finally, at the end, we've got Bryon, who is head of international ETFs at JP Morgan. Bryon focuses on Europe and Asia. He spent over a decade at PowerShares before that and was one of the earliest employees of that very large issuer now. So welcome, Bryon, and welcome all. So why don't we kick off like this? I think we can broadly define the ETF value chain in three ways, right? We've got the distributors, the manufacturers, manufacturing, design, distribution, and finally the end users of ETFs. And all of these are in various stages of change and development. Why don't we start, Bryon, with you with the manufacturing side. JP Morgan has taken sort of an interesting strategy in Europe. You've pursued both the sort of traditional benchmark products like the Beta Builder series, but you also have your active line. So at JP Morgan, how important is it to be sort of innovative in design?
Yeah, so it's a great question, and you're absolutely right. We see ourselves as kind of delivering the component parts, if you will, for a portfolio. And then there's kind of the experts that are like the folks on my left here that take those pieces and then put those together to deliver that to the investor and to the end user. I think that there's kind of two important things that I would point out. The first one I think has been made earlier on the panel, but we think about the ETF as a wrapper. It's a UCITS structure in most instances, but it's just a wrapper. And a lot of investors and oftentimes make the mistake that ETF equals passive. And that's just not true. The ETF is a technology that delivers exposure to the market, and you can put a number of different capabilities within that. JP Morgan is now entering the space, and we feel as though we have what I'll kind of call a last mover advantage in the sense that we've seen now how the market has evolved, how consumers interact with the ETF wrapper, and we're combining that with some of the things that we think we're particularly good at and delivering that through the ETF wrapper. And so we are delivering the entire spectrum of capabilities from plain vanilla passive, to your point, on up to some relatively interesting, actively managed fixed income portfolios.
And in fact, Manuela, we were speaking earlier, and you actually have found quite a bit of value in some of these more innovative products, those that follow algorithms, that do kind of away from the traditional benchmark. How do you use these, and what value do you see in these?
Let me first say that, I must admit I was totally wrong with ETFs until like 3 years ago. I was, very skeptical. I thought, I'm never going to be able to use ETFs, especially in segregated account for private banking clients and high net worth individuals. How can I justify, that I put ETFs in these portfolios? Then what happened, is that first of all, it was more and more difficult to find active manager that could actually beat the benchmark. So I started to ask myself, am I paying the right people the right amount of money? And unfortunately, the answer in these past 3 years has been no, I shouldn't pay these people for the type of job that they are doing. And then there is another factor that actually leads me to believe that more and more we're going to use ETFs, even for big portfolios. And it's the issue of interest rates. They have disappeared. Basically, we do not have any more, risk-free rates. Even corporate bonds, offer an yield that is ridiculous compared to the type of risk and duration that you have. And then there is another point, is the fact that the classical asset allocation, you remember the efficient frontier, that you had this positive slope, does not exist anymore, because basically, you have to classify asset classes, no matter if they are bond or equity, it's either risky or no risk. And if it's no risk, it's negative yield. If it's risky, then you might expect to have some positive return. But basically, you do not have a hedge anymore. So what I started to look at in the ETF world, are there strategies that allow me to minimize the volatility when I have a negative view on markets? Are there strategies that are not correlated with the beta of the market? And to be honest with you, it was easier for me to find this kind of strategy in the ETF world rather than the active world. Okay, and this was, to me, I was astonished. I would never have expected it.
And do you find that there are adequate ETFs in Europe available?
Absolutely, yes. I would like to have more, and especially the issue for me is liquidity and size, because of course we manage, quite big amount of money. But I found very interesting, strategies, mean vol, sector rotation, sectors, because another, I would say, new thing that I am doing in my portfolios, I would have never thought I would do until a few years ago, is that more and more, especially on the equity side, we are looking at sectors rather than the difference between one geography or the others.
Yeah. And so you're a fan of innovation. The other side, to play devil's advocate, innovation can go too far. And I open this up to the panel. Are there areas in the ETF world where there's a risk that we over-innovate, to bad end? Does anyone have a view on that?
Well, Richard hasn't spoken.
I haven't spoken. I mean, from our perspective, I think probably the answer is yes. But we, I think, ironically, given that we're a fintech, we're relatively conservative in terms of the approach that we use for selecting ETFs. We have a clear bias towards large liquid ETFs. And I guess it reflects the client base, which is a retail client base that expects to have that liquidity available for them. And so we're wary of the more extreme ends of it, the triple levered, some of it's a cliche, right? The triple levered stuff. The relatively smaller, maybe niche products. It'll be interesting, I think, to see how active, the point was made earlier about the changes the SEC is looking to put through, how active ETFs develop, and whether you can kind of match a product that's designed primarily to be a broad index product to actually take on potentially some of the liquidity risk of having a more concentrated portfolio that you probably need to have if you're not going to become a closet indexer. But we typically stay pretty close to home in terms of being conservative about our ETF selection.
It's a bit of a different perspective there. What about the argument that the best portfolios are the most boring ones? Manuela, do you buy that, or is that just not possible today?
To be honest with you, I don't know what it is, a boring portfolio. I haven't found it yet, because markets always surprise me. But to be honest with you, I think that, let's say, the traditional strategy, if you look at the equity space, then you have, I divide the portfolio manager between the people who look for, growth in companies and the people who look for values. And I think that this is, to be honest with you, obsolete in terms of way to approach equity markets. And I think that there are certain companies that probably will not exist in 5 years' time and 10 years' time, and maybe I have to be worried. Okay, I'm not sure that the banks are going to, let's say, survive there now. So this is why I think we are really, I think, very close to a huge change in terms of not only economic scenario, but also the companies that are going to survive this macroeconomic scenario that is developing. So therefore, I really think that we have to start to look at companies with a different paradigm.
Okay. I think Manuela makes a fantastic point that ties to your point around innovation, and a lot of what we're working on in the industry is developing products to help achieve a more specific outcome for the investors. And so we're able to provide a more tailored solution to investors, and by having the innovation that's going into some of the products that are being developed, the ability of professionals to put those together in a combination to design the ideal portfolio for investors increases by definition. Now, going back to the innovation question, we've got two choices. we could either completely stop innovating today and be done, or we could continue to innovate knowing that inevitably we will over-innovate something. I'm not willing to accept the first answer, and so we have to accept the second answer. And so it's up to us to be responsible in how we think about that, knowing that we're always keeping kind of our North Star in mind, i.e. the client outcome. And if we're keeping that piece as the objective of what we're trying to do, then I think we can innovate ourselves to a thoughtful spot. And the market will kind of naturally identify areas that are actually adding the value that investors actually need, and some of the other things will just go to the wayside and eventually be kind of retired.
So responsibility and innovation.
Absolutely.
And what about fees? Going back to the manufacture of these products. So we're now in negative territory. Where does this end? Is there room for more innovation in fees? Is this sustainable? Can they still? Are we going more negative? I
feel like Richard's negotiating me down right now.
No. I'm not saying anything. You keep going. You keep going.
We won't put you on the spot, Bryon, but we know where a lot of this sort of stuff comes from, some of the securities lending activity by the ETFs. Is that sustainable? Are fees still going to go down? What do we think?
You want to start? I mean, I hope so.
There it is.
The securities lending is really a question for Bryon, right? Is it an underestimated risk? The pushback that you get when you make that point is, well, look, we got through 2008, 2009 without any major problems on the securities lending side. I suppose you can come back and answer, well, yeah, but ETFs are now much bigger than they were, and so the potential for this and prices are lower. And so I guess more of the P&L of an issuer is dependent on securities lending, but I'll let you comment on that.
So it seems the question's coming my way. So can the prices go down? Yes. Will they go down? Yes. Will the emphasis continue there? No. And what I mean by that is we will continue to innovate, and the price will be less and less important in the overall decision-making process of what we're trying to build. So if we go back to the ideal portfolio for Mr. and Mrs. Investor in Italy, and we're trying to build them something that helps them achieve their financial goal, i.e. retirement, i.e. a second home, i.e. pay for their children's college, what have you. If we're building the portfolios that are helping them achieve that, the price becomes a less important thing in that entire value chain. The delivery that gets them there is the more important thing. And so I think too much emphasis is being placed on fees right now. I think what investors should be doing is identifying very clearly what their objective is, identifying what products are out there to help them deliver that, and then pay a reasonable price. But if you're sorting an Excel spreadsheet and just picking the one with the lowest cost at the very top, you've probably not done a good job for your clients.
And let me add one thing. To be honest with you, I don't think that this significant reduction in costs will continue forever. Not just because otherwise, the whole industry will go bankrupt. But price at a certain point becomes, first of all, a stimulator for mergers. So what's going to happen in the industry, and I think it will happen first in the asset management industry, and then it will happen in the banking industry, is that the weaker players are just going to be, to disappear, okay? And this will happen both to the ETF, companies and the active, fund managers. But then I'm willing to pay a good price for somebody who, is able to deliver innovation, who is able to deliver products that make sense to my portfolio. And I think that the issue is not price, it's always what you get for the price that you pay. And to be honest with you, price is not the main, let's say, determinant of my investment decision. It has never been, it will never be.
Sure. Yeah.
Look, I mean, just may add one more thing. We can say that clearly cost is something that you can identify up front, so it has that visibility, and that's extremely valuable. I take the points that prices won't come down forever, and that's fair. There's probably a little bit more to go in terms of the difference between the passive product and the active management world, and so price is still a conversation worth having. But at the end of the day, what you care about for your clients is the net return and the net outcome that you generate, and price has to be part of that conversation. Because having a really cheap ETF that doesn't deliver what you expected or delivers it poorly is not doing the best thing for your client.
So Richard, actually, let's stick with you because I wanted to move over to the distribution side of this equation. There have been massive changes in innovations in distribution, brought on largely by robos such as Moneyfarm. So what on earth are you guys doing to the distribution chain? What's changing?
I think if it's changing, it's still changing relatively slowly, right? I mean, at the end of the day, we're still a relatively small player in the space, and sad to say, traditional players are not just going to roll over and give us their business. But hopefully they feel pressure, and I have a lot of sympathy for the poor fund manager, whose fees have always been that much more transparent, and so they have borne the brunt over the last 15 or 20 years of their overall, on average, inability to outperform over time. But the cost to the final consumer, there's a big part of that that's on the distribution side. Those costs are much more opaque. They're much more individual. They haven't got the same focus and attention. And so gradually, and it's MiFID II is obviously will be a big part of that over time as it gets fully reflected. But I think you're still very much at the start of the process by which the distribution chain and the profitability in the distribution chain begins to get squeezed.
Okay. Why don't we go to a poll question, because I know this is going to spark some debate. So if I could ask the audience to take out their phones, please, and I'll ask this of the panel too. So go to our event app on the phones, to the polling section on futureofetfs.app. And the question is this one: do you consider artificial intelligence, AI, an innovation in investing or marketing? Is AI in innovation in investing or marketing? And we'll see how cynical or starry-eyed the audience is. So what do we think on the panel? Bryon, you were smiling
50,
like
50.
a megawatt smile. On this, yeah.
Oh.
What?
Well,
Yeah.
so I don't know what my answer is yet. Hold on.
Are you just going to go with the...
You're waiting.
It's both. It's both, right? So will it actually improve outcomes? Yes. Is there something to its ability to enhance portfolios? Absolutely. Are we, as an industry, probably going to talk about it too much? And to Tim's point earlier, kind of overpromise. There could be an element of that. It kind of makes me think of kind of your earlier question that all ties together, right? Like it all has to do with the entire ecosystem that exists here. And there's so many participants in that controlling for one variable is only part of the equation. And so if you have to think about the entire set. But there's firms that have tremendous amount of data that, when used in the right way, can absolutely help provide better outcomes for investors. And also, and I'm sure Richard can chat about this as well, but talk about investor behaviors at the interaction level. When market volatility comes, how do we make sure that we kind of ignore some of our normal behavioral tendencies and stay tight or make changes?
Yeah.
Okay, I think actually they are going to be more important for investing rather than marketing. I mean, what is artificial intelligence? I mean, artificial intelligence, first of all, they started developing this type of algorithm when I was very young, okay, in the 60s. And so, it's been around for quite a while. I mean, the difference between now and 30 years ago is that, this algorithm, now they have the computational power of current computers that, of course, was not there 30 years ago or 20 years ago. And the other thing that they need is the capability of accessing a huge amount of data, okay? Artificial intelligence algorithms, they work a little bit like us. They learn out of, mistakes. And then they repoint, to look for the solution. So basically, if you think of, for instance, Amazon, how better Amazon has become in understanding what is your most likely next purchase. I mean, I always get surprised. They always know what I'm about to buy. And maybe because I buy lots of stuff on Amazon, so now they, almost in real time know what I'm going to buy. So my question, and I keep asking myself, how long will it take for somebody to start understanding in real time how the sales of a company are going to go? Yeah. And in a certain way, you can apply this not just to companies, but to economies. So if we are going to have much more powerful computers in the future, and the answer is yes, because they already developed a technology, which is quantum computing, that allows to create computers that are, n times faster and more powerful than the most powerful computer that you have now. Then in terms of capability of storing, data, a huge amount of data, to be honest with you, I think that there is no doubt about it. Yeah. Then to be honest with you, I'm afraid that maybe 50 years from now, my job will not exist anymore. Okay? So, I think I have great confidence in artificial intelligence.
So AI is definitely a buzzword in innovation. Another one is the millennial, which is another feared demographic. Asset managers can't seem to get their heads around what they want. Richard, Moneyfarm, are they a large part of your client base? And if so, how do you cope?
I think it's fair to say that they're probably a smaller part of the client base. They're a large part of the client base. They're probably a smaller part of the client base that our founders expected them to be when they founded the business. And on some level, that makes sense. If you've been, go back to the Amazon example, if you've been buying from Amazon for now 20 years, sad to say you're not as young as you used to be. You're probably not a millennial anymore, but yet you've somehow grown up digitally.
Sure.
And so your comfort level potentially to engage digitally with your for an investment solution is maybe much greater than it was for your parents' generation.
Got it.
So I would say that yes, millennials are an important part of, and they, there are different cohorts in how they want to interact with us as a business, with us and how they want us to interact with them as clients clearly varies by cohort. But the idea that, or the implication that people over the age of 40 are not digitally aware is not quite so fair.
Overblown. Huh. Great. Why don't we look at the end users and how people are actually using ETFs? Bryon, you see this all the time in your job. Today, you can buy ETFs on exchange. You can buy them. We've heard a lot about RFQ platforms. What's the sort of most innovative thing you see now in terms of how people are using and trading ETFs?
Well, I think it's a really wide spectrum, which is one of the things that I think makes ETFs so special. We talk about it being a democratizing product where everybody from individual investor trading, on home, their laptop, their personal account, on up to some of the most sophisticated institutions, sovereign wealths around the world are accessing markets through this ETF technology. So we think that that's innovative in and of itself. I always kind of scrunch my nose at the innovation question. The ETF industry is $5.8 trillion now globally. The mutual fund industry now is about $45 billion globally. That's still a small fraction, something like less than 10% of all investable assets globally. So to think that oh my goodness, all these innovations that have happened over the last 3 years are like this thing, the adoption level of ETFs is still so low that it's just got so much to go, right? The stat I love about this one, to completely confuse everybody, but do you know how many people still own VCRs in the USA? VCRs, remember, VCRs, right? 17%. 17% of people in the USA still use VCRs. And so when we think about the ETF as a transcendent technology and something that for the end user will lower costs, will give more efficient exposure to the marketplace, will help them build better portfolios, the amount of time that will have to pass for all investor behavior to change for those to be fully adopted is measured in decades. And so the innovation is here, but is just beginning and will continue to happen for the next 60 years of your career.
Hopefully.
And actually, we'd be remiss if we didn't hit on ESG. And Manuela, actually, it's convenient we're on you. You had an interesting statement. You said that in 10 years, everything will be ESG.
Yeah, I think so. I mean, I have a strong opinion on this. First of all, it's because I think that first of all, I think that climatic change is an emergency. I mean, I do believe it's an emergency, and that more and more people are going to realize very soon that we cannot postpone, the decision to really start living in a more sustainable way for us and for the planet. So I strongly believe this. And which requires that companies have, of course, to play a much important role in this. And I think that we have, investors have an enormous power. And I'm not just referring to the big investor, also, to the small savers, okay? We can decide how we allocate our saving. We can decide, who do we give our money to. And my impression is that at a certain point, people are going to realize that there are certain companies that just do not deserve our saving. And at a certain point, the industry, will start to adopt this, kind of criteria. So for a sustainable economy and for a sustainable world. So I don't know if it's going to take 10 years, 20 years, or I have to work for another 60 years before I see this. But I think that there is really no alternative. When I see at the speed at which, the earth is really, getting sick. I don't know if you realized, the reason why I'm saying this is because I like very much to go to the mountains. For the past 30 years, I've gone to the mountains, walking all over the place in the world. And when I see that at 6,000 meters, you don't find snow when you should find snow, then I really realize, how rapidly the situation has changed just in the past 10 years. So this is why I'm thinking it's going to happen, and it's going to be faster than what we think.
So you have put us in a reflective mood. So one last question to the panel, and this is kind of interesting to reflect back on how far the ETF industry has come. What's one innovation in the ETF space that could have happened over the past 10 years, whenever, that you point to and say, oh, that was a real game changer that sort of kick-started things? Bryon, what is it for you?
Yeah, I think Slav said it earlier. I think fixed income delivered through the ETF wrapper is a completely transcendent thing for investors. We're taking something that did not trade on exchange, that traded OTC, delivering it through a wrapper that has the characteristics that you can get real-time pricing, price discovery, you can get full transparency into exactly what you own, you can get immediate diversification, and you can see the exact way that the fixed income investors are actually participating in the market. I think that is transcendent to how people will invest over the coming years.
Manuela, what about you? What's the innovation?
You mean innovation in the sense of?
What's the biggest development that you count as sort of a game changer?
In my job, I think that more and more we have, first of all, to make the decision that we have to invest, taking more risk, okay? Because at the end, if we don't take more risk, we're not going to deliver any sort of return to clients. And therefore, I think, the idea of allocating capital to the companies that really deserve it is going to be the driver.
Okay, and Richard, you?
No, I agree with Bryon. I think that, the ability to build a well-diversified multi-asset portfolio for retail investors, the development of fixed income ETFs has been critical to that. It's always been, or for many years, been relatively easy for an investor to go and buy a single share, but going to buy a single bond of a corporate or a high yield corporate has always been a much more difficult thing to do. So I think that's been critical.
Great. We'll leave it at that. Thanks very much to the panel. Big
Thank
round
you
of applause.
very much. Thank you.
Thank you, Yakob. That concludes our program for the future of ETFs. I want to thank all of our speakers today, all of you for joining us, and give a special thanks to our sponsor, Vanguard. If you don't have to head off immediately, we do encourage you to stick around for lunch, which will be served just outside this room. It's also rare that we have a room full of thought leaders like yourselves, so we'd love to hear back from you about what you thought of today's panels. There's a feedback section on the app, so let us know what you think, what's good and what we can do differently. There's also one of these little cards from Vanguard on your tables. I would encourage you to fill that in so that you can stay in touch with what Vanguard is doing to innovate in this field. We're still on Twitter, so please continue the conversation using the hashtag #TheFutureOfETFs. Thank you very much and enjoy the rest of your day.
Well done.
Thank you. Yes, I'm fine. I feel fine, but I sound terrible, so it's just one of those things. Better than yesterday, believe me. yesterday. Brilliant. Always a classic textbook move. Yeah, it still feels like it's a bit odd, to be honest.